Hi, I'm Sean Hyde, certified business appraiser from Canyon Valuation, located in Twin Falls, Idaho. I like to present a little bit about various valuation topics, and today I want to cover the discounted cash flow method and talk about how it's applied and how it's used. So the discounted cash flow method is one of the two main methods business appraisers can use to estimate the fair market value of an ownership interest in a privately held business. The way the DCF method works is it looks at the future earnings of a business that are typically expected to vary. There's going to be some volatility involved, either slowing growth over time, or there's a change in operations of the business where they've opened a second location, have hired a new sales team, come out with a new product line. There's some reason for the expected variability to happen, or volatility in their expected growth. So there are several things we have to keep in mind about the application of the discounted cash flow method. And let's get into some of those now. The first thing I want to talk about is the IRS's Revenue Ruling 5960, which really is the business appraiser's Bible. It points out several factors that we need to keep in mind. First off, valuation of privately held securities is, in essence, a prophecy as to the future and must be based on facts that were known or knowable as of the effective date of the project. So business appraisal is date specific. What did we know as of this date, and how will that affect future growth? A sound appraisal of a closely held stock has to consider current and prospective economic data. The economy will affect the value of a business. The economy that's growing and doing well will help decrease the risk of a business's operations. An economy that is shrinking will help increase the risk. So that will affect value conclusions. And typically, for valuing an operating business, earnings is the most important thing to pay attention to. Now, we can also appraise privately held businesses that are holding companies, but that's a whole different story and video. We'll do that later on. So, in 5960, we learned that valuation is a prophecy as to the future. Therefore, every valuation project includes some sort of a forecast, even if the appraiser does not necessarily know that's what they're doing. I've seen an awful lot of reports where they'll do a weighted average of historical earnings. They'll do like a 5, 4, 3, 2, 1. And if the business is growing at a stable rate, I don't care how you weight the historical earnings, you're going to project next year's income to drop. Interesting, yes? The reason I ask about those is what are you doing here? Do you expect income to drop next year? I'm usually told, no, I'm being conservative. I say, well, actually, you might be being wrong, because if the business has been growing at a 2 or 3, 4% a rate every year, if there's no real reason to expect a decline in the projected year, why are you forecasting it? Things to pay attention to. And also, something else you have to pay attention to is in the length of the forecast itself. I've seen an awful lot of businesses where their forecasts are all 5 years long. Now, the DCF method works by forecasting out that period of volatile growth before reaching out that point of stability. So the question I ask is, are all businesses always 5 years away from their point of stability, their point of maturity? Likely no. So, which is why in this case, that I'm going to show at the end of this presentation, I did a 2-year forecast for very specific reasons. But we'll get into that a little bit later. So business appraisers measure 2 key variables. We're measuring the income the business is expected to generate, and we're also measuring the risk of receiving that income going forward into the future. So the idea is, what is that income going to be, and how risky is it? Will that business income actually be received? There are another group of appraisers who focus way too much, I believe, on the historical earnings. Don't worry too much about those. We rely on the historical data to help us predict the future. But in reality, we don't care too much about it because the value of the business is based on what we believe is going to be happening going forward. So watch out for that. Now, risk. How do we measure risk? There are several different methods that one can use. The build-up method, the weighted average cost of capital, the inverse of a market multiple, the factor rating method. If you don't know what any of those are, you can let me know. I'll be happy to answer those questions later on, or I'll address them in a later video. But whichever method you select, the appraiser needs to know if a certain adjustment might be required to maintain an apples-to-apples comparison. For example, if you're looking at using one income stream, and that income stream is not designed to be used with the rate that you've selected, or the method that developed that rate, you need to make some adjustments to make sure we can maintain the apples to apples comparison. And we're going to talk about that in just a little bit. I believe, yeah, it's the next slide after this one. So we have to support our selection of the risk rate. A business appraiser needs to be able to explain to the reader of the report, the user of the report, where we get our rate from, how do we come up with that, what did we analyze, what's the impact of the economic, industry, and overall business analysis that we've been doing, how will those affect our value conclusion and risk analysis. And it's our judgment that will take the end up rate that we select from one of those methods and convert it into a mathematical representation of the risk of investing in that particular business itself. Businesses that are stronger than the industry average, I typically do an industry financial ratio analysis where I'll compare the subject's operational characteristics to industry averages through ratios and other analyses to see, is the business operating better than or weaker than the industry average? A business that is operating stronger than the average might theoretically be worth more. So if it's less risky, value tends to go up. Higher the risk, lower the value. Lower the risk, higher the value. That's how that works. So if you do select a risk rate, but you don't match it with an appropriate income stream, you get screwy values. So the value of the business does not change just because we chose to measure it with a different income stream. Let's go to an example of a length of a 2x4, say a board this long. You can measure the length of that board with a tape measure, and you can tell how long it is in inches, centimeters, feet, whatever the scale you choose to use is, the length of the board does not change. So the value of the business is the same. It does not change. We can choose to measure its value using net income, EBITDA, net cash flow, gross revenues. We just need to modify the rate to match. Because if you end up with, measuring a board and you say it's way out here, but the board's actually, shorter, it's a screwy value. It's a screwy number. It doesn't make sense. So let's pay attention to, well, here's an example, the next slide here. Folks have typically heard of the rule of thumb, a business's value is worth 5 times EBITDA. That's been around for many, many, many years. And if you have an EBITDA, or EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So if we have an EBITDA of $250,000 times 5, the value would be $1,250,000. Easy, right? But let's say we apply that 5 EBITDA multiple instead to revenues. The overall value is quite a bit different. It doesn't make sense. This is a much more emphasized example, but be careful about applying the rate, in this case a 5x multiple, to the wrong income stream. It happens fairly often. So the forecast is the key component. So we analyze historical results to help predict the future. There's trend analysis. We'll look at the common size factors, expenses and assets as a percentage of total to see what they have been historically. We're going to consider the economic impact of risk drivers throughout the economy. If a business is reliant on discretionary income of the population and discretionary income is expected to decline, will that have an effect on the operations of the business? It might very well. Industry drivers, same kind of thing. There might be certain factors that will specifically affect the value of our subject, and we need to know what those are. So we can take all of that information and we incorporate all of it together and write up our report to explain how all of that had an impact on our overall analysis. So the DCF method works based on the time value of money theory. This theory operates by saying we typically rather have the income that we're owed now, today, rather than years in the future. So you'd rather have $1,000 paid to you today or 2 or 3 years down the road. The idea is if you have that money owed to you, $1,000, and somebody says, hey, I'm going to sell this note that I owe you to somebody else, what would that somebody else pay for that note? Well, based on the present value of that income stream, say what's the risk of receiving that income stream? So if it's $1,000 over 3 years, the discount rate will be X, and then they'll pay probably $450 or so for that $1,000 to be received in 3 years. That's kind of how it works. So here's how that present value factor is calculated. 1 divided by the quotient of 1 plus the discount rate raised to the power of the time. If you look at your keyboard, Shift 6 brings up that little arrow. Well, that little arrow is how Microsoft Excel knows to do the mathematical function for exponents. So it could have present value of different income streams to be received over different years. That's how we calculate those. So I'm going to open up an Excel file. I've changed a few things in this one. This was originally it was a real assignment, but I've modified several things to be able to share it with you today. I'm calling it Custom Home Improvement Things LLC. And before anybody asks, no, I'm not going to share the actual Excel file because I have an awful lot of other stuff in there in my personal template that are difficult for those to use who aren't familiar with them. I have written a simplified version of my Excel template and step-by-step instructions on how to build one in a book that Business Valuation Resources has made available. I'll put a link to that in the comments down below if you're interested. So we're going to look at my 5-year historical trend analysis because I collected 5 years of data from the company. We're going to look at the comparative analysis. I'll look at the ABV method just a little bit because it's there. I'm not going to spend much time with it. I'm going to look at my normalization schedules and the projections. I'll play with those just a little bit so you can see what the effect is on the overall value. And we're going to look at the application of the DCF method. And I need to remember to talk about the mid-year convention. That's going to be fun. So if you have any questions, my phone number and my email address. But let's get into my exhibits here. So, Excel file, financial spreads. I like to put my balance sheets and my income statements on the same sheet because I'll use formulas to grab data from my financial spreads, either the balance sheet side or the income statement side. I want to be able to grab them all at the same time if I want to. So this is how I organize it. So these are tax returns for the operating period, and here's my operating expenses. So there's that, and here's the common size. So here's the numbers, spread from the financial data, and then these are common size, or percentage of total assets for the balance sheet. You can see the math, divide inventory by total assets. And then down below, these are expense or income, whatever it is, divided by total revenues to get the common size of that. Then I look at BizMiner as my source of choice for financial ratios. So I download data from BizMiner into a CSV file, which is a basic Excel spreadsheet, copy it, paste it into a sheet in my template, and then I use these formulas to bring that data across and format it in such a way that makes it look comparatively pretty otherwise. And I can use that to compare with my subject. Again, if you want to know how to build these types of formulas, link to my book will be in the comments below. But here's all the data, the ratios for industry averages, and here's the company data. The formula for the company data is a little bit easier. This is a little bit shorter formula here because I'm grabbing data down below. I'm going to scroll down here, the summary sheets. So here you can see the index match formulas, grab the data from the spreadsheet that I downloaded from BizMiner. Then down here, I'm just doing sum ifs of the financial data spread on the 5-year summary statement over here. So just getting all the information presented so I can do the ratio calculation and make sure apples are matching to apples, that I'm calculating the ratios that BizMiner calculates using exactly the same data for the subject company. It's very important. And then further down, I've got the common size version of those, and further down below, the definitions of the various ratios themselves. That becomes important when I calculate my charts. So this schedule by itself is kind of ugly, really. It's just a bunch of numbers, really hard to read. So I create charts and graphs where I show the company ratios. So this line, the red one on the bottom, is the company data. The blue line is industry averages. And then the ratio definition is what BizMiner shows. So everything on here is tied to a drop-down menu that's grouped away. So I'll see this formula down here that bases it off of this label of the formula of the ratio and grabs that specific ratio's definition. So what I do when I calculate all of these charts, I don't recreate them every single time. I create them once, copy it, change the drop-down menu, and everything self-updates. So if you're interested in seeing more about that, again, my book is available. So I'm going through and looking at my risk analysis based on ratios and financial characteristics of the business. Your receivables are low, inventory is much lower than industry averages, gross fixed assets, net worth, discretionary owner earnings, all the way through. Then this, got to change my zoom so it fits on the screen, is the adjusted book value method. So from the tax returns that I was given for the first 5 years of data, my effective date is May 31st. I don't have a May 31st tax return. I have December 31st data. So my effective date is as of May 31st. This information needs to be provided from the May 31st income, or balance sheet rather. So that's where this information is coming. And here's the detail is for the furniture, fixtures, and equipment that I did not have on the tax return. So I'm taking, in this application of the method, I assume that the equipment is going to have some value of less, somewhat less, than its original cost. So I take this math formula, which is right there, and I can incorporate the percentages, my estimated percentages, of what the equipment might be worth as a percentage of original cost. So this one is 15% original cost. So if it was 37 grand, it's now worth fair market value estimated 5,500. So vehicles are worth more than showroom displays and computer equipment. See, so that's how I've done that. I'll scroll down so you can see the rest of the schedule and my notes. Pause the video here if you want to read these notes. I'll scroll through a little bit pieces here so you can see them. There you go for that. And then this is my normalization schedule for the income statement. I'm removing from the operations an expense for an estimator's market salary, as well as a bookkeeper's compensation, because that is what the jobs are for the two shareholders who do not pull a salary out of the business. They pay themselves from distributions. So I'm incorporating the salary estimation here to show what the true earnings potential of the business might be, because I'm going to calculate net cash flow at the very end. Because I'm incorporating extra salaries, I have to incorporate the extra payroll tax adjustments to calculate those. The rent expense that they pay is much lower than the market value of the rent they should be paying. So the real estate was appraised. So I'm able to incorporate the data from that real estate appraisal to identify what the fair market value rental expense should have been over these historical periods. I calculate the taxes. Here's the net cash flow adjustments. Add back the non-cash. Subtract out the capital expenditures. And changes in working capital calculation. Changes in long-term debt is 0 because they have no debt. So I'll scroll down to my notes here. Again, pause the video if you want to read all the notes. I'm going to scroll through fairly quickly. There's that one. And then this is how I calculated, let me go back up just a little bit. This is how I calculated the estimated capital expenditures. I looked at the balance sheet summary for fixed assets for each year and calculated the difference. Now this factor is a rough analysis because I don't have the data to see if they had anything that was expensed in the year's sale. I don't know if they had any trade-ins, which would affect the amount they actually spent, because the balance sheet's fixed asset line won't count trade-in value of things. But this is what I have to work with. So then changes in working capital. This is how I calculated that step. I looked at total cost of goods sold. I'm going to bring that back up so you can see what I was looking at. Total operating expenses. This is all the money they spent that year. Divided by 365 days. So it's an estimated daily rate times 30 days. So that's the estimated required working capital for that year. And then just do the change down below. Is this the only way of doing it? No. Is this the correct way? Maybe. Is it the reasonable way? That's what I'm looking for. Business appraisers are trying to project and show a reasonable mathematical solution to solving these problems. So from there, we'll jump into my projection. Change the zoom so you can see that better. This column is actual 2020. This column is projected 2021, projected 2022. So you can see the label here that 2022 E is added to it. So that's done because I'm showing an expected or forecast income stream. Now, right here, where I select my growth rates. So right now I have 15%. You can see if I change this 15% here to something unreasonable, say 600%, this changes, so does my note. I tie them all together. We'll talk about that again in a little more detail later on. So let's look at, purchases. This is my forecast. 52% of revenues. How do I come up with 52% of revenues? Why am I using that? Well, let's go back and look at the financial spreads. And that is right here, scrolling down to the income statement. And what were purchases as a percentage of revenues historically? Well, it's ranged from 44 to 61. The average of all is 52.46, 52.5. But it has been trending down over the last couple of years. So extra purchases in 2019 may be part of the reason why their profitability was down that year. But anyway, so I chose 52%. Let's get rid of this. That's how I came up with my estimation for purchases for the cost of goods sold forecasted. And all the way down, let's get to the expenses. I did something similar for discounts. So in discounts, they had only discounts in 1 year, in 2020. But I'm thinking this is something that they're going to have going forward as well. So I did a projection. I picked 1.5%. If I go back and look at the original spreads, let's find discounts. You can see there it is. Only happened once so far, but I think it's going to happen more times than that. All right, let me scroll down some more. Look at the math here. So rent expense, they paid 12, should have paid more. They own the property. So per the real estate appraisal, plus some math that I'm incorporating, I'm changing it. Now this formula, the mid and all this other stuff, is helping me grab the 3% factor from my label. So actually I'm having this is tied to my long-term growth rate. So I'm going to fix that, well, temporarily. I'm going to copy that, I'm going to paste it as a value, and now I can go in there and change that 3% to something else. Watch this 42 and that 43 as I change this. Let's go to 5, enter. Slight changes. Let's make that more obvious. Let's go to 50%. So the math that I'm doing is tied directly to the percentages listed in my notes. So I can build my forecast out pretty easily. Let's hit undo on this a few times. I don't want to have that hanging out there yet. I'm doing the same kind of a thing with my salaries and wages. They only paid $48,800 in 2020 for salaries and wages. Well, that does not incorporate the expenses for their estimating person or their bookkeeper, which in my normalization adjustments, I had summed. So this formula is grabbing that, right? Incorporating it. And then down here, I also have the payroll tax adjustment incorporated as well. So that's how this forecast is done. Now I want you to pay attention, scroll back up to my pre-tax net income. 122,000 for 2021E, 116,000 for 2022. So if I go to my projection, well, before I get to there, we got to show you the determination of the risk rates, right? Let's change the zoom so you can see that better. I'm using the build-up method. So I have my risk-free rate, equity risk premium, size premium, company-specific risk premium. There's my discount rate, my long-term growth rate. Subtract that from my discount rate to get my capitalization rate. There's some notes explaining how I got there. Scroll back up. Now, let's change the zoom here. This is my forecast. So I'm starting with projecting that pre-tax income. Remember I told you to look at that forecast just a little bit ago? It was a different number. The 116 is here, but why is this 71? Let's go back to the forecast. Why is it not 122,912? That's what I forecast out. Well, this is for the years ended December 31st. What's my effective date? May. My effective date is May 31st. Let's open this formula up. So I'm grabbing that 122, but I'm doing some extra math with it. Let me scroll down to see what that math is. May is 5 months of the year, 12 months in a year, therefore it's 41.7% of the year. I'm only calculating the present value of the unreceived income, so June through December, so 58.3% of the year. That is what is showing here for the application of the discounted cash flow method. Now there's other ways of going about doing that, but this is how I chose to do it in this particular case. So I go through and do my net cash flow adjustments. Here's my terminal value calculation, where I'm taking the net cash flow of 2022, growing it by 1 year, capitalizing it, and that's the value of the business in the future if it were sold on May 31st, 2022. Well, let's calculate the present value of those future income streams, and that's the value here. So point out here, I have to point out the present value factor for the 2022 year and the terminal year are exactly the same, because the terminal value happens like the day after the last dollar is received for that projected income stream. So there's no difference in time, therefore there's no difference in the present value factor. So that's why those two have to match. So there's my indication of value. Now, because I use the build-up method to calculate my discount rate, the build-up method comes from publicly traded companies, which brings with it some liquidity characteristic to the indication of value. We'll be dealing with that in a little bit. I'll show you. But for now, let me scroll down and show you my notes to all my adjustments, applications of the method. You can see what I've done here. So what I'm doing here with these, I'll show you the formula that goes into these things. I'm doing what's called dynamic text, linking certain cells into my notes. So if I change a cell's information, the note itself will self-update. So good stuff to have. So then I've got the excess earnings method. I'll change the zoom here a little bit so you can see that. Well, I'm not going to spend much time on that. Here's my reconciliation. So adjusted book value method, excess earnings method, discounted cash flow method, less my illiquidity discount. So my conclusion of value for the subject business is 387, rounded to 390. So that's how that works. And then here's the BizMiner data. This is what it looks like when you download it. It's just a long list of stuff. So if you have any questions about the DCF method or any other valuation related questions you'd like to have answered, give me a call, send me an email. Happy to chat. Thank you very much. Take care.